Okay, here we are. It is May 12th, Friday, May 12th, and this is the weekly review. So, Richard, we've had a little bit happening over this last week. We got away from the boring range, at least for now. We've seemed to have broken out a little bit out of the bottom. What are your thoughts this week and what's happened?
Uh, as you know, I'm not a big um, predictor of directions. If ever I predict something, you should probably assume it's wrong. Um, we've seen some quite violent moves up and some quite violent moves down, a few more of them down than up, some of them in the same day. And the magic number seems to be about $1,000 on Bitcoin, $1,000 up, $1,000 down, and then 2 days of $1,000 down each day. Um, last night, yeah, it was about 5 p.m. We had $1,000 down in 1 minute on Bitcoin,
Mhm,
which is quite an aggressive sell-off, and then didn't continue. And
mhm,
it's it's almost as if the market participants are just getting bored. We've got realized vol down to just over 30% in Bitcoin. We've got implied vols around about high 40s. Um, I'm still kind of reluctantly selling vol, but stopped selling long-dated vol.
mhm,
So in our business, we systematically trade vol, and at the moment, we for the past 2 months we've been net short vol, but getting less and less comfortable with that. But I still don't see any drivers for vol increasing. We maybe we'll get onto a bit later. I look at the shape of the volatility surface. That tells us, informs us a lot about what's going on, and what we're kind of seeing is that certainly over the past week and certainly since yesterday, the skew is very much down now towards the downside in the first
mhm.
out to 1 month or maybe 3 months. Beyond that, the skew is still towards the upside, so the long term, feeling is up, but in the short term,
Always is.
the sentiment's down.
Mhm,
However, implied vols in option prices, the at-the-money vols are not rising; they're falling, which tells me that market makers are positioning to perhaps not pay put sellers quite so much, but no one really believes it's gonna fall off a cliff at this stage.
Yeah, and I just took a quick look here while you're talking at the devol on Deribit, and for both Ethereum and Bitcoin, it's just it's around 51% or whatever it is. It's not moving very much. Actually, why don't you if you've got the surface volatility there and the skew, let's just take a look at that and talk us through what you're thinking.
Can we see that?
Yep, I can
Here's,
see it right now. Yep.
here's the Deribit
Hmm.
story. There's the sad story of just continuous. I mean, the thing is that when you look at these sell-offs in it's sort of in a micro view down here, if you look at the 1 minute, it all looks terrifying, right? When you're there, when it's happening to you, it looks terrifying. When you come out to 3 months, it's like nothing. There's
Hmm.
nothing going on really. Okay, sure, we're a little bit lower than we have been in the past 2 months. Big deal. Right? So I can kind of understand why no one's getting excited because Bitcoin does move around. So if I put up the vol surface,
So are we looking at Ethereum right now or Bitcoin
this
over?
is Bitcoin I'm looking at. Yeah, I'm currently trading more Bitcoin than Ethereum. So what's it telling us? Well, out in the wings, we're up to 65, 70, almost 70 on the downside, maybe 60-ish on the up on the calls. At the monies are sort of 47, but where it really counts, because most people trade in this zone of the vol surface here.
Mhm.
All that stuff is, you know, super long dated, particularly if you're a crypto bro. So where are we? June 7th, the 50 vols, 46%. June May 26th, 50 vols are 47%, 46%.
Quite
And then if
low.
you get, and then down into 1 week, you're getting, well, it's falling off a cliff down to like 40% vol because nobody believes it's going to move very hard anywhere.
And just for anyone that's watching that isn't familiar with the volatility surface, one side is puts, one side is calls. It's just showing, the further towards the back is the longer dated, and then the wings on each side is the volatility. That's the
So
volatility.
yeah, so and you'll see that this is across here, this axis at the bottom. I assume you can see my mouse.
Yep.
We see it in terms of delta. This is 20 delta puts, 20 delta puts, sorry, 40 delta puts, 40 calls, and 20 delta calls. And then this, of course, is up to more like 10 delta and smaller. what you'll tend to find is that retail options traders tend to think in terms of strikes because that's what they see on the exchange. People in the profession who do this day in day out with other people's money don't think in terms of strikes. We think in terms of vols. So actually, the 10 delta calls out here in December are way up at, like, I don't know, $60,000, right? But the 10 delta calls down here with 1 week are probably more like 28,000 dollars. This graph is not linear in terms of strike; it's linear in terms of delta. If you were to paint it linear in terms of strike, it would be a much more spread out towards the back months, and it gives us kind of a view of sentiment in options pricing. If you were think of take each date line along this surface and just think of one slice through the surface, you can think of that as a smile. We call it a smile, and if the smile can be even, which means that puts and calls are kind of equally weighted in terms of price, and it can also be a smirk. It can be either a bit sad or a bit happy on one side, in which case you've then got what we call skew. And if the skew is more towards the puts, as it is, then it means that sentiment, at least today, is that people are willing to pay more for puts than they are for calls, and vice versa. So what we're seeing at the moment, if we look at this end, and I'm thinking of looking at only. Yeah, that's July 28th. That's miles away, 3 months away. Here, June and May is just here. You just see that the top of the puts is higher than the top of the calls. So there's just this kind of. I think that what this surface is telling us is that no one really thinks it's going to move very far. But if it does move a long way, it's probably slightly more likely to go down than up.
Yeah, and that's interesting. So something I want to point out here is okay. So I think you did a good job of a clear job for people who maybe never seen a volatility surface before, don't know what the skew is. But we've talked about this before, where hey, we don't know what the price is going to do from day to day. Nobody knows. So let's say we had a brand new market, a brand new stock or crypto or whatever it happens to be, and it opens and it's $100. Well, if we looked at the smile, it should be even on each side. I mean, nobody knows it's going to go up or down. It should be an even smile. And that's that randomness where the market's perfectly random. It could be up tomorrow, it could be down tomorrow. We don't know. It might be the same price. Who knows? But because we've seen a bit of a sell-off in the last day or two here, and we've seen it. So that's when we talk about the markets not becoming so random, because if the market starts to push heavily one way, it tends to keep going that way because people have to take action. They have to cover. They want to jump on the bandwagon, whatever, and it pushes the skew. So that's why the sentiment is a little bit off to the put side. Now that doesn't always happen, but that's typically what happens. And that's why I think we talk about the market being mostly random, but not completely random.
Yeah, there's definitely patterns in the market. I mean, what I do in my work is systematically analyze these volatility surfaces and look for. We actually monitor the shape changes. In the book I trade a strictly delta neutral book, which means that we keep delta strictly at zero all the time. Which means that we never really care which direction the market's going to go in. What we're actually trading is the shape of this volatility surface. If you think that, for example, 46, 47 delta is too expensive at the moment, then you'd sell it. And if you think 47 delta is too cheap, then you'd buy it. Similarly, if you thought that the 10 delta, vol out here in July at 60% is too expensive, you'd sell here. And if you thought it was cheap, you'd buy it, and so on. So I'm actually more concerned about the shape of this vol surface and actually how that shape evolves as the market moves up and down. So we do quite a lot of mathematical work on finding correlations in the way that spot moves and how that affects the shape of this surface. And that's how actually we make our money.
Yeah, that's really cool. And that's fascinating. And I think the thing is, for a lot of people, it's like, oh my gosh, this is so complicated. And it can be a little bit complicated, but you've got you're crunching some big data. So for the average person, you're not going to sit there all day and hedge every minute or two, or every 5 minutes, or every hour. Right. But I think there's lessons that we can learn from this, and we're going to have courses coming out. So, for example, you just said, hey, if you determine that 47 vol is cheap for this particular call or this put, you could buy it. Or if it's expensive, you could sell it. So a lot of people are saying, okay, so then what? If it's cheap, then do I sell it for more later? Well, ideally, yes. But what we can do is we're going to look at incorporating strategies for retail people where, all right, you determine that something's a bit cheap, or it's cheap because the market's going the other way. We buy it, and we hedge immediately, and then we wait for the market to turn, and then we sell. Or we're selling the other side. So let's say we bought, and we'll talk about this a little bit later on. The market's screaming down for some reason. There's some news that came out and the market's going down, and everybody's panicking. What a great time to buy some calls. We can hedge if we chose to at that point so that we're neutral on those. Then when the market comes back up, we can sell front spreads. We can sell vertical spreads. We can use those cheap calls we bought as insurance when we're selling against it, if that makes sense. But I think what I'll do is, when you're finished sharing this, we'll look at the charts. So when you look at a little technical analysis, nothing crazy, because I think we both like a little bit of technical analysis, but we don't lean on it too heavily. But we use it to gauge, to judge generalities. And for most retail traders, they're not going to be doing this precise stuff. I like to say it's more like horseshoes and hand grenades. You don't have to have these precise entries and these pinpoint things. All we need to do is be close, and we're going to be fine with options, because we've got probability on our side every single time we make a trade. So is there anything? So I think you were saying earlier too, before we got on the call, you're talking about the skew had changed, would become a bit more compressed, and that was leading you to believe that market makers weren't really on board with this down move, at least right now.
Yeah, so what we're seeing, so when I look at the vol surface, I'll show you the way I look at it. The numbers I see. Can you see that?
Yeah, it makes perfect sense. Yeah, exactly.
Okay, so that picture you've just seen, I can summarize this in this set of numbers, which is we look at the volatility in the one week at the money. ATMF means at the money forward. 1 week, 2 week, 1 month, 3 months, 6 months, 9 months. And then we look at the 25 delta butterflies and the 15 delta butterflies and 10 delta butterflies. And then we also look at the risk reversals. And this is like a shorthand way of describing that shape. And I think what's salient here is that if you look at for example, the 10 delta butterfly, so this is describing how curved the vol surface is on the 10 delta. So that's quite far from the money. And we've got about 10% of curvature, which is quite steep. And we've also got minus 7% of risk reversals, which means that the puts are 7% more expensive than the calls in terms of volatility. Now, 7% doesn't sound a lot, but in terms of 40 vol, 7% is actually 25% more expensive. So today, the 1 week puts are quite aggressively more expensive than the calls. So if you didn't think, for example, that this sell-off was real, today might be a good day to be selling puts and buying calls. So that's one way to view it. Now, another way to view it, which you'll find crazily counterintuitive, is that, so I see this as somebody who sort of sails on the vol surface. I would see it the other way. So I see this put as expensive, yes, but remember that I delta hedge every day. So I'm not looking necessarily even for time decay. I'm looking for the change of shape in vol surface. And so if I stay delta hedged and I sell a 10 delta put, and then if you can imagine the market goes up, if the market goes up, that put gets further from the money. So it gets down to 5 delta, 2 delta, 1 delta. So what happens on this graph is that actually it gets the vol gets more. So actually I lose money as the put option gets further from the money, which is counterintuitive to you because you'll sell a put option hoping it'll expire worthless. But to me, what's happened is I've actually walked that put up the smile, and it's become more expensive. So I will lose money on that. Whereas if that put walks down the smile, i.e., as that put gets closer to the money, and more dangerous from your point of view, from my point of view, it makes me money. So it's kind of, and one of the things I love about options is that there's so many ways to trade them, because you can trade the surface sideways on a smile like I'm doing here, or you can trade it back and forth on the forward curve, as we call it, this difference between the front and backdated vols and so on.
Yeah, you're right, and you bring up a really good point. So the average trader wouldn't even have a clue about this. So typically, and there's nothing wrong with that. So typically, people learn that, hey, you want to sell high, buy low, sell high. Right? And when people are selling options, they're hoping that option expires out of the money. So for the typical option seller, if I sold that put, oh gosh, I want the price to go up so that it becomes worth less, and I'm going to buy it back cheaper or let it expire. But what you're saying is, because if if it actually the price does start to go up and get closer to the money, volatility increases.
Yeah.
And that's what is that's bad for you. So we could take the exact same position. It would be good for me. It would be bad for you, but you're delta hedging every day. And just one thing I'll mention too. So delta is a Greek measurement, and there's 4 ways which we typically use delta. And the one way here to quickly explain. So when you're talking about a 10 delta call or a put, basically we're using it as a probability tool. Where the market is saying, hey, there's about a 10% chance that option is going to expire in the money. So it's a long shot. That's great if you're an option seller because you want your options to expire out of the money or to be, if you hold it to expiry. So if I bought that 10 delta option, I want that, I need the market to go my direction. If it's a put I bought, I need the market to go down. I need to be right on direction and timing. So it's buying options is what most retail traders do when they get started, but it's the last thing they should do when they get started because you've really got to know your stuff. But they see less sort of those lottery tickets. Hey, someone spent $500 on some five delta calls, and boom, it exploded, and that $500 is now worth $15K. And that's a lottery ticket. It happens maybe 1 in every 10,000 times. But the steady way to make money from a retail standpoint is selling, and we mostly sell even with our discretionary trades. And once I start sharing my screen too, I'll talk about some possible strategies coming up if the price moves to the areas we think it might move to, and we can talk about buying and we can talk about selling at both those areas. And there's nothing wrong with either. Like you said, there's a 6 ways to Sunday to make money with options, even when we take the same position and you can lose on it and I can win on it. It's bizarre. It's not like just buying and selling a stock. It's much more complex. But don't get confused by all this stuff because we've been doing it for a long time, and you just got to start one step at a time. But it's nice to see deep in to see, okay, hey, that volatility surface, actually it's not so scary at all. It's just simply these slices of time down the tunnel, 6, 9, 10, 12 months out, and what the market is pricing these things at and seeing where the volatility is at according to delta. So I think that's really interesting for people to look at and to play with. So if you go onto the Deribit platform, for example, you can just click on one of the trading tools on the top and look at the volatility surface, and you'll see it change from day to day. If tomorrow we get a huge rally for some reason, Asia wakes up and boom, they have some whales buying, we're going to see that volatility surface change. We're probably going to see the skew, the smile go off to the right-hand side. Everybody's like, oh, we're going up, and we see that kind of that sentiment change.
Yeah, I think it's also after about a month of selling options, people often say, I wonder who buys these things. Because on the whole, selling options sort of makes you money. Well, on the FTSE 100 where I started, you'd make money sort of 9 times out of 10, 9 months in 10. And in crypto, you might make money, I don't know, 4 times out of 5, maybe, depending on how the markets are moving. And then, because option sellers often win more than they lose, they often then say, well, who's the idiot buying this? But I think what I was trying to illustrate earlier is that there are people out there doing different things with options than just looking at the price and taking essentially a directional view or a sort of a very like a caveman view on vol. So if you sell a put and a call, you're saying I'm betting that the market's going to stay in this range. It's quite a coarse bet. Whereas there are people out there saying, yeah, I'll take that bet, and I'll take that bet to use it as part of my shaping strategy to say that actually, even though I think you're going to win, that actually hedges off some risk for me, or it causes me some P&L that I need, and I'll deal with it some other way later. So it's kind of a everybody wins kind of game, or can be. I mean, clearly somebody's losing, but hopefully not us.
Actually, let's talk about us as idiots buying those sometimes because we could just be covering. Maybe we sold them out, we're buying them back. But let me share my screen and we'll just look at the chart. Unless there's anything else you wanted to mention there, I'll just go ahead and.
Well, you mentioned buying puts. So even though I run a systematic strategy which looks at the volatility surface, there's one truth in markets, and particularly in crypto, which is that if things are going to crash up, they generally do it over a day. or a week. If they're going to crash down, they can do it in a minute. So actually, I do buy puts. I buy more puts than I need. And even though I'm running an auto hedger, which sits there and monitors my delta every 2 minutes and hedges it to zero with futures, I even buy puts just in case that thing fails and I'm asleep and I can't get to the market and there's a crash. And there's like a one in a, I don't know, 100,000 chance of that happening, but I can't afford because I'm trading money that isn't mine. I can't afford that to even be a factor. So I burn money in order to make sure that never happens.
Just a quick note here. Are you usually, when you're auto hedging, are you using perpetual futures or are you using a monthly contract?
Perpetuals. I do leave an order in to swap perpetuals for futures. So if I show you, let me quickly share again.
Mhm.
Maybe it's worth just showing this quickly. I don't want to get too deeply into it, but if you go to the strategy screen on Deribit, and then you can see that they've got this section called future spreads, and you can actually set a price for whether you're willing to the net value you place on selling one and buying the other. So I tend to leave an order in on this just in case somebody's desperate to convert the other way. And I leave it, obviously, I leave it in my favor. But in a rising market, I tend to want to be long dated futures and short perpetuals, because in a rising market, the perpetual tends to trade above the spot, and in a market that's full of FOMO, fear of missing out, people often trade the perpetual much higher than it should be, and therefore it generates lots of carry costs, which come back as profits if you sold it. So in a rising market, I like to be long, short the future, and in the perpetual, sorry, and long the futures. And in a falling market, I prefer to be long the perpetual and short the futures for the same reason. Just so I don't get any nasty surprises in terms of cost of carry. But on the whole, I just do all my hedging in perpetuals and then think about hedging that away later. It's just easier. The perpetual market's just more liquid.
Yeah, and I mean, I don't want to get into perpetual futures and how that works necessarily, but so you talked about doing one or the other depending on the market's going up or down. If I don't do that, I just use I'll pick a futures contract 2-3 months down the road, and that's the one I'll use. And then I'll just choose the next one as we get close to expiry, just so I don't have to worry about that and deal with it.
I think there's great value in if you're doing sort of retail style vol selling. So you're selling, for example, a call spread or a put spread, then it makes a great deal of sense if you're going to hedge that position with futures. And often sometimes it does make sense to. I know one guy who used to sell a call on the FTSE 100. He'd sell 10 calls and buy one future, and that worked very well for him for most of the time. So if you're going to do that, then you're probably better off having the future expire at the same time as the option, because then you're not left with a sudden delta switch as soon as the option expires. If you're hedging with perpetuals, and if let's say you're in the money, I don't know, 10 bitcoins of calls, and you're in deep in the money, and you're therefore long 10 bitcoins of perpetual, then the moment those calls expire, you're suddenly gone from 0 delta to plus 10 bitcoins delta.
Yeah, you get a margin call or something. Yeah,
you'll be a margin call, and also everybody else in the market. If you're in the money on your calls, probably everyone else is too. So they've all been doing the same thing. And people like me with an auto hedger will be within 30 seconds. We'll sell off perpetuals. So I will cause the market to drop before you can get yours sold.
Yes.
So, right. So be very wary of that.
So there's two important lessons here. If you lose money on this, it's Richard's fault. But in all seriousness, though, when we're talking about with the retail traders or people who are new, do things simply. Don't sell naked. Make sure your expiries line up so you don't end up with these. Something expires and then you get thrown the other way with delta and margin calls and oh my god, what's happening? Just do things very, very simply. So let me
don't sell naked and absolutely do not sell naked puts. If you're going to sell naked puts, you need to really know what you're doing.
Let's not go too deep there because we only have a certain amount of time. Let me see if I can share my screen here. Sorry, a little technical malfunction there. You can see this?
I can see. Yeah.
Perfect.
I can see your graph. Yeah.
So here's a Bitcoin. I'm still over at TradingView, and this is what I wrote last week. I was like, hey, you know what? We're down at the bottom of this range at the time. I said, look, if it busts down, this is kind of no man's land here, and this is my unicorn level. There's a few things I want to say about this chart. I don't rely on technical analysis. I like to use it as one particular tool. We've got obvious, support resistance down here. It hung around here for the chance of it blasting through that like a hot knife through butter is very, very slim. It could, there could be a big news event and, Bitcoin's going to zero and to go through it. Sure. But if we get down here, if we start going down here aggressive, there's a few things I'm going to start thinking of. On the way down, I'm not going to do a lot with puts. I'm going to wait until it gets down to this unicorn level. And then we can look at maybe selling some put spreads. We can sell some put spreads, maybe down around this area or something, because we feel pretty confident that, hey, if it busts through, it's not going to do it quickly. It'll give us some time. It'll bounce around for a while. The theta will decay out of it. We'll buy those positions back. Happy days. Wonderful. And again, I'm just drawing these lines sort of arbitrarily. Maybe our short strike would be here, and our long put strike would be here or something. I don't know. But these are just rough numbers. It'd probably actually be more, a little bit higher, to be perfectly honest. But we'll wait till this price comes down, let those premiums get nice and juicy, and we could sell a put spread. Nothing too crazy about that. That's a nice retail strategy. As things are coming down, the safer thing to do would be to sell calls. And do we sell naked calls? Yes, we do sometimes, not all the time. But I'd say, look, as it's coming down, I'd feel okay about selling calls, up here in the range. If we start getting down this, I'm going to sell call spreads up here all day long. But the one thing two other things I'll mention. As you said, there doesn't seem to be a lot of conviction here. Did it bust below the range? Yes, but it could go right back up into the range tomorrow, simple or easy, or Monday. We could be right back here next week, back in this stupid range. That's fine. That is fine. There's not a lot of conviction here. It wasn't super high vol. We'll see. We don't see the skew heavily, people piling on the put side and jabbing those premiums up. But what we were talking about earlier is if this starts to plummet down hard, what we can do is we can start to buy calls because we're going to see the smile be heavy towards the puts. That means those calls are really cheap. So we'll be those dummies, those people who are like, who the heck is buying these super cheap calls? There's no chance, right? There's no chance. We're not buying them as lottery tickets, though. We're not buying, a 28,000 call or a 29 or a 30,000 call, thinking that it's going to blast up through it and make us a whole bunch of money like a lottery ticket. What we're going to do is we're going to buy those. Sometimes maybe we have short calls. We might be buying them back. But here, if we didn't have any position and it comes down here, we're going to buy these cheap ones. Let's say they're a little bit longer day. Let's say they're 3 months. We're around 90 days out or something, or 60 days out. Well, we know the price will like to bounce around. Maybe it'll come down to here. Maybe it'll push back up to here at the highest. Wonderful. We can sell some calls. Let's say we bought some 29,000 calls. We can sell the 28s against it, the shorter term, but we have those longer dated calls. Now we could sell the exact same expiry. So let's say we bought 60-day calls, and in 15 days the market rises back up. We sell some calls. We can sell the exact same expiry calls against that, if that makes sense. I might have went through that too fast, but is there anything you want to add to that strategy?
No, I think when we get to the hands-on workshops, it'll become clearer for customers, viewers rather. I was actually going to say that narrative you gave about your thinking behind, if it comes down to this level, I'll sell puts, but not yet, and I'm happy to sell calls right now. That actually is exactly, if you think about it, what the vol surface is reacting to. So the fact that we're seeing the risk reversals the skew heading down, it's favoring you selling puts and penalizing you for selling calls, but without the conviction of the increased at the money vol. So there's no the at the money forward vol is what I see as the conviction level in the vol surface of how convinced market makers are and the market in general that the trend will continue. Mm-hmm. And we're seeing no conviction at all from that point of view, but we're seeing like a current intraday or intra-week pessimism. Mm-hmm. Yeah, and that's the prices get that way because of narratives like yours, which is like, yeah, if it goes further, I'll sell puts, but not yet. but I'm
Mhm.
happy selling calls now, which is exactly what we're seeing in the vol service.
Yeah, and the one thing I'll also mention too is sometimes I like to call it the gift of being flat. So a lot of people are they don't have any positions on, they want to earn some theta decay or whatever. We get this little breakdown here. I mean, it's just as likely next week we're going to be back up in the range, but they get excited and they sell some puts too early. But if this is the beginning of a bit of a downtrend, you're better off to wait and let it do something stupid, really scare the bejesus out of a few people. Let it get down here and really start getting some people panicky, then sell some put spreads. It's very tempting, especially if you don't have any positions on your board, to jump in a little bit too early. And we can see here the ETH chart. We're not even through the bottom of the range. I mean, we've got the bottom of the range, freaking down here. I mean, we're just sort of kind of getting to it, and it's sort of the top of the range from over here. So Bitcoin looks a little bit more likely to want to go down versus Ethereum from a very high level technical standpoint. But I'll just say one more time, if this thing comes down, if it does come down here, what a great opportunity to buy some super cheap calls up here. Those might expire out of the money and worthless. We might have wasted every cent on them, but they were super, super cheap. But if we do get a nice bounce, we can sell calls against them, maybe several times. If we buy September calls, for example, well, we can sell May's, we can sell June's, we can sell July's, we can sell August against those Septembers, and we can make it pay us over time. So by the time we got to September, we sold 3-4 rounds of monthly options. I mean, there's also weeklies available too, but there's a lot of opportunities to make those cheap calls pay you, because they're giving you the insurance that if this thing did explode and go up to 2200 or something, you've got limited risk, right? Because you have that insurance, cheap calls that you bought cheap insurance is basically the way to look at it. I don't know how else to explain that without going a bit deeper, just chatting.
Yeah.
So what do you think is going to happen? I mean, so over the weekend, crypto's famous. It's 24 hours a day. Not a lot of people around on the weekend. If I see a low volume move, it's a great opportunity for me, in my case, to sell very short term against it, because it's almost guaranteed that by Monday morning it's going to go right back to where it came from, because it was just someone easily pushing the market around in a low vol environment. But what do you think we got on deck for next week? Without making a prediction, but what do you think we're going to see?
Yeah, it's interesting that you say that, because this whole sell-off kind of started last weekend on a Sunday. On Sunday, didn't it? There was this big sell-off on a Sunday that nobody expected, because you kind of expect people to just go home and not do anything, but of course then people fiddle. What do I expect? I just think the market's tired of going up. There's no kind of, there's been a few press stories in the press about Bitcoin 60K, Bitcoin 100K over the past couple of weeks. Those to me were a bit of a red flag. That sounded a bit like as if people out there are short the market and want you to buy it so they can sell. Let's be honest.
Well, here's another thing to think about. I think for some people is look, we've had all these opportunities for the market to rise, and it couldn't bust out of that range it was in over the last weeks. If that's all they got, if that's all they can do on good, or which should be viewed as good news, I think the only way it could be down, or we're just going to stay in that darn channel for a while until something really busts it out. Could we have more bank failures on the horizon? Maybe, I don't know.
Yeah, probably, but people are going to get bored of that. So that's all probably priced in now. There's, three banks gone bust, 330. Does it matter? Not really. It's all play money. One thing I tell you, no taxi drivers ever asked me about crypto anymore. And that's quite a strong indicator that no one gives a shit about crypto right now, right? So yeah, I'm speaking to fund managers, and I'm speaking to people wanting to make allocations to funds and whatever, and yeah, people have got money to allocate, but no one's like super desperate to chuck money your way. Kind of tells me that there's no FOMO behind all of this. People are concerned about, are their dollars going to go to zero, and are they going to get replaced by yuan, and are we going to have to all salute the Mao's red book before we get paid every month? Do we want an alternative to that? Should that alternative be property or gold or something?
Mhm.
I don't think anyone has any strong views about it, right? Apart from the few foaming at the mouth crypto bros.
Yeah, you're right. The fear has died down. And you talk about the taxi driver effect, and I can remember back in 98, 99, at the top of the tech bubble. I was working retail order flow for TD Waterhouse, and I remember people who worked at like front facing the clients who would come in off the street, and they were telling me that guys were coming in, kids with skateboards were coming off the street, and they had $200 in their pocket or something. They wanted to buy whatever, anything, you know like, okay,
Yeah,
that's time to get out. It was time to get out when you
yeah,
got the guys on skateboards, and not to disparage guys on skateboards. Yes, there's lots. I'm just saying that when you just get the regular folks who aren't in the industry, and by the time they're in, it's time for you to get out. So, interesting analogy about the taxi drivers.
yeah,
All right.
yeah. I mean, I mean, it literally is taxi drivers. I mean, whenever I take a taxi during a bubble, whenever they learn I trade the markets and I manage a fund,
Hmm.
they're all over it. I did have one couple come and talk to me last week, asking for advice, and I, resolutely did not give advice. But the husband was kind of keen to get into crypto because he thought it was cheap. The wife was less convinced, and I sort of said to them, well, one way to resolve your differences is maybe dollar cost average into a number of things rather than
Hmm.
all in on crypto,
Yeah.
which is about as subtle as I felt I could be, without giving advice. And I think, then 2 years ago, the wife would have been, no, we're just going to go all in crypto, But when the wives are saying, no, let's just do something else, then yeah, there's no FOMO here, right?
Yeah,
Uh,
for sure.
and halving or no halving, no one believes it yet.
This week. So what I'm going to look for is if we go back up into the range, I'm happy to sell call spreads or maybe even an iron condor on each side of the range. If we continue to go down, I'm going to hold tight. So I'm going to be short futures to offset any loss of holding the underlying asset, maybe a little bit heavier, so we can make some more of the underlying asset because we'll be losing US dollars in that case. But I'm going to wait until we get down close to those unicorn levels. Then I'm going to look at start selling some puts, probably some put spreads, not naked puts. That's my plan. I fully expect that the plan won't work out because I don't think that crypto is really going to do too much right now. As you said, there's not a lot of sentiment, but maybe it will. Who knows? We could have a news story come out tomorrow and change everything. But that's my plan: is to sit tight on the downside, wait till we get lower, then sell put spreads. We pop back up. I'm happy to sell the top of that range and call spreads.
Yeah, I think it's sounds as reasonable as anything else. Yeah.
Okay. And then, the other thing I didn't mention too, let's talk about this next week. If we do get down those ranges, and I hope we do get some more downward pressure so we can talk about having this develop, then we can talk about, if those people who have conviction, they say, it's going to bounce off 22,000 or it's going to bounce off, 1450 for ETH, whatever that number is, then we can talk about some high gam trades. We can talk about some near-term expiry long trades, whether we do it as a naked long or a long spread. But let's put on the shelf. We'll talk about that next week.
Okay. Yep.
All right, cool. Thanks, Richard.
Okay. Bye.